as a professor at Harvard and Georgetown before entering the government, enables him to really have a rigorous framework for expressing and explaining very important ideas in financial regulation. His speeches really are, you can trace the evolution of recent regulatory thought through Dan's speeches, so much so that the leading textbooks in the area don't even bother doing anything other than just taking his speeches and putting them in there verbatim. We've learned a lot over the years from his previous talks at Yale. I'm looking forward to learning a lot more today and really getting an opportunity for everybody in the Yale community to see how important some of these topics are in the post-crisis world. Since the financial crisis, there's been a lot of new thinking and careful thinking about how to do financial regulation. And in the United States, the dean of that thinking is Dan Tarullo. So following his speech, which we expect to be about 35 minutes, we will have a Q&A period that will go until about 12:45, and I encourage everybody to think up some good questions. Governor Tarullo.
Thank you. Thank you, Andrew. It's a pleasure to be back at Yale to give this speech, and I think nowhere better than here at the management school, where you all are on the forefront of trying to reorient academic studies to take account of the lessons of the financial crisis. As Andrew has previewed, this is a speech about stress testing. Supervisory stress testing has become a cornerstone of post-crisis prudential regulation. Stress testing, unlike traditional capital requirements, provides a forward-looking assessment of losses that would be suffered under adverse economic scenarios. The simultaneous testing of the largest banks lends a perspective on a large part of the banking system and facilitates identification of common exposures and risks. Today, I want to share with you the results of an extensive review of the Federal Reserve stress testing programs, which we began following the end of the 2015 stress testing cycle. Now, this is going to be, as Andrew said, a somewhat longer speech than my normal 25 to 30 minutes, and I hope you'll bear with me, but there are a lot of results to report. And I should add that even so, my oral presentation here is about 40% reduced from the written presentation, which you can get on the Fed website. Before turning to the review itself, I'm going to take a few minutes to summarize the characteristics and purposes of the programs as they've evolved to this point. So as the Federal Reserve has implemented the statutory requirement for stress testing, which we call the Dodd-Frank Act stress test, or DFAST, we hypothesize adverse and severely adverse macroeconomic and financial market scenarios, and then use our own supervisory models to project each bank's losses, revenues, and capital over a 9-quarter planning horizon under the specified scenarios. In itself, though, DFAST does not do the things the public probably now associates with stress testing, that is, setting capital ratio requirements or limiting capital distributions by firms. That we do through the CCAR program, the Comprehensive Capital Analysis and Review, which we created to assess the overall capital adequacy of the roughly 30 banks that have over $50 billion in assets. In the annual CCAR exercise, we evaluate whether each firm's capital provides an adequate buffer for the losses that would be incurred during the stress scenarios, whether its risk management and capital planning processes are appropriately well developed and governed, and how it plans to distribute capital through dividends or share repurchases could affect its ability to remain a viable financial intermediary in the hypothesized scenarios. Under CCAR, the Federal Reserve may object to a firm's capital plan on either quantitative or qualitative grounds. A quantitative objection is made when the stress test reveals that a firm would not be able to maintain its post-stress capital ratios above the regulatory minimum levels over the planning horizon, taking into account its planned capital distributions. The Federal Reserve may object on qualitative grounds if it finds that the firm's capital planning processes are not sufficiently reliable. If we object on either quantitative or qualitative grounds, the firm may not make any capital distributions without our permission. We regard the stress testing and CCAR programs to have made substantial contributions to protecting the safety and soundness of the nation's largest financial firms, and to promoting the stability of the financial system as a whole. But equally clearly, if a stress testing regime is to continue to play this role, it must be dynamic. As appropriate, changes in scenarios, models, and processes have been and will continue to be made from year to year. However, after 5 years of post-crisis stress testing, we believed it was important for us to conduct a more thorough assessment of the program. We knew there were several areas to which attention was needed, but we also wanted to hear what others thought. Accordingly, we met with bank officials, debt and equity side market analysts, public interest groups, and academics. As you can imagine, we received a wide range of suggestions. In the main, though, these discussions reflected strong support for stress testing, reinforced our going-in view of the key issues for consideration, and presented us with some other areas for possible change. Before describing the package of potential changes that is emerging from our review, let me explain a bit more about each of the key topics we had identified for attention. First is the fact that CCAR has been adjusted to align with some, but not all, of the important changes made in our regulatory capital rules over the last 6 years. In some particulars, as I will explain a bit later, CCAR sits a bit uneasily alongside the ongoing capital requirements. So our first self-identified task was a better alignment of the ongoing regulatory capital requirements with the CCAR program. Our second key topic was the macro-prudential dimension of the stress testing and CCAR regimes. One of the most important lessons of the financial crisis was that prudential regulation, including capital regulation, had been dominantly micro-prudential in nature, even for the largest firms. That is, the regulation was designed and applied with a view mostly to the idiosyncratic risks faced by a bank in isolation, without regard to the interaction of the bank and the financial system as a whole. Our stress testing and CCAR regimes do have some macro-prudential elements, such as varying scenario design to lessen pro-cyclical effects, and not allowing firms to plan on a reduction in their balance sheets through cutting back their extensions of credit as a way to meet capital ratio requirements under stress. Still, as currently conceived and implemented, our stress testing regime emphasizes the direct risks to bank capital from a severe recession and associated market dislocation via the usual channels of reduced operating revenues combined with credit, market, counterparty, and operational losses. A fully developed macro-prudential dimension to stress testing would incorporate indirect risks to bank capital through channels such as market-wide funding and liquidity disruptions, fire sales, and so on. These amplification effects are obviously particularly important for firms that have relatively larger trading books or that rely relatively more on short-term funding, or both. The third topic we had identified for review was the nature of the qualitative assessment as it applied to the relatively smaller, less complex firms within the CCAR exercise. While we had always explicitly differentiated our risk management and capital planning expectations for these firms, that is the ones that are more in the $50 to $100 to $150 billion range, our supervisors had observed that many such firms seemed uncertain of whether they would nonetheless be held to the more stringent standards intended for the largest, most complex firms. After more than a year of discussions and analysis, we have developed ideas for changes to the stress testing and CCAR regimes that would address these three key issues, along with some related matters that arose during the course of the review. Some of these changes would need to be pursued through notice and comment rulemaking. Others can be implemented through non-regulatory change, but will still need further elaboration in moving from idea to concrete practice. Thus, there is a necessarily provisional character to the package set forth here. Except for our intended relief from the qualitative requirements for smaller, less complex firms, which I will describe a bit later, we do not contemplate proposing regulations to implement most of these ideas until early next year. Thus, any such changes would not apply to the coming stress test cycle. So now into the conclusions of the review. And this begins with the efforts better to align CCAR with our regulatory capital rules as they've evolved over the last 6 or 7 years. As I noted earlier, some significant additions to regulatory capital requirements since the first CCAR exercise in late 2010 have not been integrated into the stress testing program. Most significant are the various capital buffer requirements that sit atop the regulatory minimum levels. And this chart should help you see this a little bit more easily than just through listening to my text here. So these buffer requirements, if you see the 4.5% minimum there, on top of that is the 2.5% capital conservation buffer. And then on top of that is the GSIB surcharge, which is a capital surcharge that we've enacted that applies to the 8 U.S. banks of global systemic importance. And on top of that still is a countercyclical capital buffer, which can be applied by the U.S. banking agencies as an effort in a countercyclical fashion to deal with a run-up in the amount of lending and presumably asset bubbles or concerns about frothiness in the markets. So when firms do not hold capital sufficient to meet or exceed that combined buffer level on the left, they are then subject to restrictions on their capital distributions and bonus payments to executives, which become progressively stricter as their capital level falls deeper into the buffer. So if you think about it this way, the 4% minimum is, as it sounds, a minimum. But then the amounts on top of that are, as they're denominated, a buffer. And when a firm's capital level falls below the total amount there automatically now click in restrictions on capital distributions and bonus payments. To better align CCAR with the regulatory capital rules as they now stand, we'll be considering adoption of a stress capital buffer approach to setting post-stress capital requirements that would further integrate our capital rules with our stress test and CCAR frameworks. And the simplest way to understand this, which you can see from the diagram, is that the SCB, or stress capital buffer, would replace the existing 2.5% capital conservation buffer as a component in each CCAR's point-in-time capital requirements. So again, looking at the diagram, on the right is the schematic for the CCAR stress test results. And what we would do is take the minimum amount or the maximum losses that would be calculated over the stress period, and then substitute for the 2.5% capital conservation buffer, that amount, the CCAR stress test results, into the same stack here. So there's now a congruence between the left-hand stack and the middle stack with the substitution of the stress test results for the 2.5% fixed conservation buffer. The SCB will be, though, risk sensitive and vary across firms based on the results of the stress test, rather than just being a fixed 2.5%. And the simplification here comes that it will be fixed rather than vary from quarter to quarter, which is the case under our current stress test. So as is now the case with the CCB and other applicable capital buffers, a firm would be subject to restrictions on its capital distributions whenever its capital levels fall below that now larger combined regulatory minimum and buffers. And although it is likely that, given the way our stress tests have evolved, losses will continue to exceed 2.5% of risk-weighted assets, the SCB would have a specified floor at 2.5% no matter what the model would kick out, to avoid any reduction in the stringency of the regulatory capital rules. In other words, the middle column can never be less than the left-hand column, and given past experience and expectations, it's likely to be non-trivially greater. The firm's buffer requirement would be recalculated after each year's stress test, and its capital plan would not be approved in the CCAR process if the plan indicated that the firm would fall into the buffer under the stress test baseline projections. So let me use a hypothetical to illustrate how the SCB would work. So assume now that the firm's common equity Tier 1 capital ratio, that is the amount in the burgundy or crimson, sorry, don't want to use that word here, part of the middle buffer, would decline from 13% to 8%. That is, it would be a 5% amount in that reddish area. Since that's greater than 2.5%, that would be the applicable stress buffer. And if you assume further that this is a GSIB, one of the biggest firms that has a surcharge of 3%, and that the countercyclical capital buffer is not in effect right now, then the firm would be constrained in making capital distributions that would bring its common equity Tier 1 capital ratio under 12.5%. So the 12.5% is the sum of 4.5%, the minimum common equity Tier 1 risk-weighted capital requirement. The 5% stress loss is calculated in the stress test, and then the 3% surcharge. And so now you see how there's been a merger of the CCAR stress testing process with the ongoing capital requirements. Because the GSIB capital surcharge already exists as an additional buffer requirement in the regulatory capital rules, the stress capital buffer approach would effectively add the capital surcharge to our estimates of the amount of capital needed under stress. This would generally result in a significant increase in capital requirements applicable to the GSIBs, for most of which CCAR has been their binding capital constraint. But having both the stress loss buffer and the capital surcharge included in our capital requirements is wholly consistent with the reasons for having a capital surcharge in the first place. Indeed, not having the two together has actually been an anomaly that arose from the sequencing of the various capital strengthening measures we've undertaken. The board adopted the surcharge requirement as part of its implementation of Section 165 of the Dodd-Frank Act, which established the important macro-prudential principle that financial firms should be subject to increasingly stringent regulation as their systemic importance increases. The material distress or failure of a GSIB would have an adverse impact on the financial system as a whole that is far greater than the impact on the financial system of the distress or failure of a non-GSIB. Accordingly, GSIBs should face capital surcharges to compel internalization of those external costs. Because the difference in the external costs of the distress or failure of a GSIB as compared to a non-GSIB is likely to be at least as high during times of macroeconomic and financial market stress as during ordinary times, there is no reason why the surcharge should not be a part of the post-stress capital regime. A complementary point is that the extra buffer required by the GSIB surcharge also reflects the fact that even the best conceived annual stress test scenarios cannot capture all tail risks in the financial system. As some of you may know, Chair Yellen and I have on a number of occasions over the past year or so indicated publicly that we would be considering the effective incorporation of the surcharge into post-stress capital expectations. Some industry representatives have subsequently argued that this step is not warranted. One argument is that it is duplicative to include both the anticipated losses under stress and the GSIB surcharge in a firm's capital requirement because there are two elements of our current stress test that apply only to GSIB firms, and these are the global market shock and a counterparty default shock. But these additional scenario components capture direct losses to any firm that is engaged in material trading activity. The market shock measures the trading mark-to-market losses associated with sudden changes in asset prices. The large counterparty default measures the losses associated with repricing counterparty exposures based on the market shock, and then assuming the default of the counterparty that represents the largest net exposure. These components of the stress test do not capture the adverse impact of a GSIB failure on the financial system as a whole. It's directly on the firm itself. And those impacts on the system as a whole are exactly the kinds of risks that are the basis for the GSIB surcharge, that cost internalization concept. These two components of our stress test currently apply only to GSIBs because GSIBs are the only firms currently in CCAR for which these exposures are material. They don't apply to your $60 billion regional bank. As the U.S. intermediate holding companies of foreign banks with more material trading businesses in their U.S. operations are added to CCAR, we intend to revisit whether the global market shock and counterparty default component should be applied to firms beyond the U.S. GSIBs. Another argument offered against inclusion of the surcharge as an element of post-stress capital expectations is that the material distress or failure of a GSIB no longer poses a significant threat to financial stability due to the regulations and supervisory programs that are designed to improve the resolvability of GSIBs. It's true that these efforts have improved GSIB resolvability in recent years, but they are ongoing rather than complete. And more importantly, while there is certainly a relationship between the goals of strengthening the resiliency of the most systemically important firms and making them more readily resolvable should they nonetheless fail, these are still separate regulatory aims. The demise of a very large financial institution would cause substantial damage to the economy and the financial system, even if it was not so disorderly as to threaten the system entirely. The shift to a stress capital buffer, that is, to this middle approach, would provide a mechanism for addressing two issues related to capital distribution limitations under CCAR that have been discussed for a number of years now. The first is the arguable inconsistency between, on the one hand, the existing effective pre-funding requirement of CCAR. That is, in CCAR, we have assumed to this point that all the dividends and share repurchases which a firm says it would intend to distribute over the next 2 years would proceed regardless of how much stress the bank was under. And on the other hand, the fact that we subsequently, after the stress test began, adopted this 2.5% capital conservation buffer above minimum requirements, which, as I said earlier, has a more or less automatic limitation on the ability to distribute capital when you're falling into the buffer period. Now, this feature of CCAR reflected the fact that even as the financial crisis was unfolding, some of the largest banks continue to repurchase shares and pay dividends to shareholders, and thereby depleted capital that proved to be needed later. The SCB approach addresses this inconsistency by providing a continuous constraint on any planned distributions, because now we're seeing this as the stress loss incorporated into the ongoing capital requirements. However, given the fact that declines in observed and reported capital levels usually occur with a lag, and the historical evidence that dividends are less likely to be curtailed than share repurchases, we will assume a firm will maintain its dividends for 1 year, but would reduce its share repurchases. So this would have the effect of requiring a firm to hold capital to meet its stress losses and fund its planned dividends over the next year. So the crimson box there includes the stress losses, less revenues, plus the intended dividends over the next 4 quarters. The switch to an SCB approach would also give us an opportunity to address a second issue related to distributions. Since the inception of CCAR, we've indicated that a capital plan with a planned dividend payout ratio above 30% would be subjected to particularly close scrutiny. When this policy was adopted in 2010, we expected it would be a useful guideline during a period when most of the CCAR banks would need to continue increasing capital levels for some time. But we also recognize that at some point would need to revisit it. Since the new approach of adding 1 year's planned dividends to a firm's capital buffer should act as a disincentive for imprudent or unsustainable levels of dividends, the notion of extra scrutiny on planned dividends may no longer be useful. And we would, in any case, be reluctant to substitute a higher specified payout ratio for the original 30% ratio because we are concerned that it might end up being an implicit target for banks to try to reach. However, firms planning higher dividends should be aware that the operation of the SCB is such that if a firm planned to pay out all of its earnings in the form of dividends and things did not go as well as expected for the firm, it could end up subsequently having to cut that dividend. Now, beyond requiring that large banks have the resiliency to weather a period of financial stress, an important macroprudential aim of stress testing is to ensure that they can provide credit to households and businesses that remain creditworthy. If banks maintain their capital ratios under stress by reducing their balance sheets through asset sales or through reductions in new lending, this crucial intermediation function could be compromised across the economy, resulting potentially in a credit crunch. For the past few years, our supervisory model has actually projected not just a stable balance sheet, but growing balance sheets of the CCAR banks during the severely adverse portfolio, with varying impacts on with varying impacts on different portfolios. This assumption and its somewhat complicated implementation was designed to be fairly conservative, not dissimilar to the assumptions about capital distributions. During the course of our review, numerous banks have attempted to show why some of their portfolios or business lines would not be increasing under any reasonable assumptions and proposed ways to distinguish among business lines. The complexities of trying to differentiate across idiosyncratic business lines seem to us considerable. So instead, considering replacing the current element of the model with a simple assumption that balance sheets and risk-weighted assets remain constant over the severely adverse scenario horizon. Given that some decline in demand by creditworthy borrowers for loans is inevitable in a serious recession, this simpler assumption would still achieve the macroprudential policy objective that any such decline in lending during a recession is attributable to the impact of the recession rather than to capital constraints at the large banks. So that change is itself probably the biggest in terms of how the whole system, the regime actually functions, which is why I've taken a good bit of time to explain it. The realization of the progress along the way to the next two objectives, somewhat more straightforward and certainly don't require diagrams. The second major objective in our stress testing review was to integrate more macroprudential elements into the program. Now, combining the GSIB surcharge with the SCB approach in and of itself promotes an important macroprudential aim. The surcharges are at least a partial surrogate for inclusion of various macroprudential features in the stress test. And we're also considering a couple of relatively modest revisions to our scenario design framework for stress testing that are intended to reduce some of the procyclicality that otherwise may be involved. Beyond these steps, we considered many ideas during our review on how we might pursue our macroprudential objectives by adding new features to the stress test. And we've concluded that to this point at least, even the most conceptually promising of the ideas are good ways from being realized in specific and well-supported elements of our economic models. And one of the big reasons for this is that macroprudential risks often involve the spread of stress from one firm or market to others. So you need to estimate not just first-round losses, but knock-on effects, which depend on the vulnerabilities and responses of all major actors in the financial system, not just the ones that we regulate. And modeling these effects just requires information about all of them. And this is information actually that may not be observable either to the banks or to us. Now, although there are these kinds of practical challenges, a lot of the suggestions we received and some we saw in reviewing the academic literature have focused on important potential risks that do bear further inquiry by regulators. So we are undertaking a research program to pursue these ideas in order better to understand the quantitative consequences of new risks in business activities, amplification channels such as fire sales, and important dynamics between capital and liquidity positions. At a minimum, these research results will inform scenario design and hopefully contribute to the public discussion, and at least some might eventually be translated into features of the stress testing regime. Initially, the priorities for this research program will be funding shocks, liquidity shocks, and spillovers from the default of common counterparties. I can say a bit more about any of these in the Q&A. In the interest of time, let me just make a couple of points about these. One, and I think particularly with respect to the liquidity shocks and fire sale dynamics, A lot of the commentators who drew attention to this concern were advocating an integrated approach to capital and liquidity stress testing. Because, of course, what we're dealing with here is when normal funding channels to a firm dry up, the firm may be forced to seek liquidity in the markets by selling its assets. And the result, of course, can be fire sale-like phenomenon in which asset prices in that particular category or across categories then go down. And that results in mark-to-market losses for all firms, even those not in the fire sale. And so you can see there's a pretty close relationship between capital and liquidity concerns here. And although we may or may not be able to achieve that endpoint of fully integrating capital and liquidity concerns in a single test, I think we're going to be able to move in that direction, perhaps by using the conclusions reached in the annual stress test as a starting point for the annual comprehensive liquidity analysis and review, which we also conduct, or maybe vice versa. That is, the results of the liquidity analysis may be the starting point for the stress tests. Now I want to say a few words about transparency. Transparency has played an important role in making stress testing such a key part of post-crisis prudential regulation. Transparency of the scenarios and the results gives investors and analysts valuable information about the condition of the tested banks, which should help contribute to market discipline. It also allows the public to evaluate the job that the Federal Reserve is doing. There are three areas in which transparency considerations need to be applied. First, the set of scenarios applied in the annual exercise. And here we release essentially all details of the scenarios, and we've also published a policy statement exploring the aims and factors relevant to development of the scenarios. Second is the set of results of the DFAST and CCAR exercises themselves. Right from the start, in the 2009 original stress test, we adopted what was then the very controversial practice of publishing post-stress capital ratio results for each participating firm. Since then, we've increased the breadth and granularity of the disclosures that we make. And during the course of our review, suggestions were made for more granular disclosures, such as providing more details on different components of projected net revenues. So we're going to make a change along these lines and maybe a few others over the course of the next cycle or two of stress testing. The third area for transparency involves the supervisory models used in the stress test. The banks have regularly requested more disclosures so that they can, in their view, understand better the likely impacts on their firms. We've already taken a number of actions to respond to these requests, and we're considering further requests that could help banks and the public trace how changes in risk drivers alter loss projections. We also expect to provide the public with more information on our own internal model validation process. Having said all this, though, let me now say that we do not intend to publish the full computer code in the supervisory model that is used to project revenues and losses. Full disclosure would permit firms to game the system, that is, to optimize portfolio characteristics based on the parameters of the model and take risks in areas not well captured by the stress test just to minimize estimated stress losses. In part for this reason, disclosure of the code could promote a model monoculture in which both supervisors and firms use the same models to evaluate risks. We do not want the firms simply copying the supervisory model and thereby increasing the vulnerability of the financial system to the inevitable blind spots in even the best models. This is a stress test. The shifts in activities of banks and in the economy create a dynamic set of risks. Effective prudential regulation must be equally dynamic. As you can already tell, our responses to the need for better alignment of the stress test with the capital rules and to desirability of more macro-prudential emphasis each required a good bit of explanation. Our response to the issue of unnecessary burden on smaller, less complex firms is both simply stated and simply achieved. In a notice of proposed rulemaking that the board is releasing today, we're proposing that beginning in the upcoming stress test cycle, so this is the one change, significant change that will be in effect immediately if we follow through on this regulation. Banks with less than $250 billion in assets that do not have significant international or non-bank activity would no longer be included in the qualitative review of the CCAR process. Many of these firms have already met supervisory expectations, and we don't intend for less complex firms to invest in stress testing capabilities on a par with the most complex firms. Given their profile, we feel that these firms can maintain the progress they've made through the normal supervisory process. So the set of changes we're considering for our stress testing regime has been motivated by somewhat different considerations. Against the backdrop of what we intend to remain a dynamic regulatory instrument, whose procedures will be regularly defined and whose substance will be regularly adapted to changing economic conditions and industry practices. Still, in pulling this package of modifications together, we've consciously shaped them in accordance with the principle that financial regulation should be progressively more stringent for firms of greater importance and thus potential risk to the financial system. Two features of the package reflect this principle. First, of course, is the one I just mentioned, which is the elimination of the qualitative portion of CCAR for nearly all firms with less than $250 billion in assets. The second feature is the differential impact that the improved alignment of CCAR with our capital regulations will have on the roughly 30 firms that are covered. Let me note at the outset that the precise effects on the capital requirements of individual firms cannot be determined because of the very nature of the stress test regime. The scenarios vary from year to year, and the resulting projected effects on losses and revenues may also vary materially, depending on the composition of a firm's balance sheet and activities. But to provide some idea of what the impact may be, we assessed how the various changes I've mentioned would have affected capital requirements in the past two CCAR cycles. On average, for the 8 GSIBs, integration of the surcharge with the post-stress requirements would have been somewhat less than half offset by the simplifying changes in the pre-funding of capital distributions and balance sheet assumptions, though the impact on capital requirements will likely be greater for firms with larger GSIB surcharges. So that is to say, somewhat more than half of the amount of the GSIB surcharges would probably, or at least in the past two cycles, would have been included as an additional increment of the post-stress capital expectations. For the other CCAR firms, for which there are no capital surcharges, these simplifying assumptions will result in some reduction of post-stress capital requirements. We estimate that the aggregate impact of these changes for the 30 firms as a whole should be a modest increase in the total amount of required capital. But this increase will be totally due to the impact of the higher requirements on the 8 GSIB firms, whose increased requirements will more than offset the reductions for the others. In short and in conclusion, the GSIBs will see their capital requirements rise. All other CCAR firms will see some reduction in their capital requirements. And firms that have less than $250 billion in assets and do not have extensive international or non-traditional banking activities will also transition to a more tailored set of capital planning expectations outside the CCAR process. Now, I know that's been kind of a quick whirlwind, and as I said, it's not even everything that we've got in the prepared text, but I wanted to try to give you a flavor of the major elements of the package that we have formulated. And now, I think, where's Andrew? I think Andrew will now moderate some Q&As so we'll be able to delve a little bit more into whatever of these particulars are of particular interest to you.
Okay. Thanks very much. Do you want to sit, Dan, or stand?
No, I'm happy to stand.
All right, then we're standing. Okay, so questions, and by prior arrangement, we're going to take questions from students and not from anyone in the press. So when I call on you, please identify yourself. Just say your name and what you do at Yale. Dan.
I'm a first-year MBA student, not a member of the press. I'm going to misparaphrase this, but there's a new paper co-authored by Larry Summers talking about, sort of makes the contention, if I understand this right, that increased capital requirements, profitability, reducing enterprise value for the banks, thereby actually, ironically, increasing systemic risk. How do you respond to that?
Well, so I think the first thing I should say, I think, is the Summer Sarin paper, which was presented maybe a little over a week ago in the fall Brookings conference. I think by its own presentation was meant to be somewhat provisional work. But having said that, I make a few observations about it. One, with respect to the data set itself, they do a good bit of comparison of market measures immediately pre-crisis and in the post-crisis period. For example, they put a lot of emphasis on betas. And it is undoubtedly true that in the post-crisis period, betas have, although they've come down from during the crisis itself, they certainly haven't been lower than in the immediate pre-crisis period. But here, if you extended back the look at betas 5, 10, 15 years before 2002, you would actually have seen that the betas were higher then as well. So it may be that a broader look at some of these market measures over a longer period of time would filter out some of the idiosyncrasies that are applicable to different of these periods. Having said that, I should say that I think it is, if no other reason than heuristically, a useful exercise to try to see whether there has been a reduction in betas over the past 4 or 5 years. And I think there's been some in the last couple of years, but we want to look to see whether that trend is verified over time. Another comment I'd make is that it's important to understand whose perspective one is taking. Now, I think the paper largely takes the perspective of an investor, the kind of risk that an equity holder or a bond holder sees in holding a stock or paper of one of these banks. And I have no doubt but that, for example, for that bondholder, there is a risk in holding that bond which may not have been as apparent or even real in the pre-crisis period, which is that that bond may well not be repaid because of what I mentioned in the speech. We now have a resolution regime, and we have actually a regime coming into force in which some bonds are specified for conversion into equity if there is resolution. So to some degree, I think some of the perceived decline in franchise value may actually be something that reflects an effort to deal with the too big to fail problem. Another element here, and I think, again, that the authors, I think, are very upfront about saying there are a number of hypotheses for why franchise value has declined, one of which might be underappreciation of risks in the pre-crisis period, another of which may be the fact that we're in an environment now in which some of the business models in the pre-crisis period were revealed, quite apart from regulation, not to be sustainable. We are in, obviously, a very low interest rate environment. Some of the regulatory things, such as the large fines associated with the look back at the crisis, may actually be a bit more cyclical than secular. So there may be a lot more things involved in the franchise value. And I think the authors sort of reflected their intuitions with some supporting reasoning. But I think our reaction has been that a number of the other hypotheses may have something more to them. So as you can see, I took the paper in the spirit in which I think it was offered, which is here's something kind of provocative but tentative. There's a line in the paper somewhere that I completely agree with. I think and we all should take it to heart, which is we can't get complacent here. We can't get complacent about the efforts that we've made, and we as policymakers have had to take action and move forward with the knowledge that we have and the best sense that we have. But we should all welcome the efforts to see, okay, how much of an impact has there been? Are there other things that need to be done? I mean, to strike one of Andrew's themes, how much migration is there outside of the regulated sector? I kept using the term dynamic or dynamism to refer to the way we think about our stress tests, but really we've got to think that about the regulatory system as a whole. And I take that paper and many others in that spirit as something trying to contribute to what needs to be, continual and non-defensive reflection by regulators to see, okay, where have we made progress? Where might there be questions about it because of things that are happening, and what do we need to do in the future?
Yes, in the back.
I'm Tarullo. Mr. Tarullo, you spoke about transparency and how the model, reviewing the model would result in banks gaming the system and probably accumulating assets closer to the stress test. I understand that, but wouldn't the Fed's regular oversight of banks prevent this from happening if you regularly monitor banks to make sure they are not gaming the system? And secondly, by revealing the model, wouldn't that help to identify certain blind spots better by allowing academics, industry experts to comment on it as well?
Right. So I think, with respect to how much we can see and examine, I think it's hard, it's a little, you don't want to overstate the capacity of even the best supervisory and examination teams to see absolutely everything going on in every business line at every bank. And so let me just give you a little example to indicate what I mean by the gaming a little bit more concretely. And let's sort of assume it in the context of FICO scores. Okay, so suppose you look at FICO scores and you say, roughly speaking, as we look at the distribution of FICO scores and the associated risks, and I'm going to put aside for a minute the question as to how accurate or something they are, but let's just stipulate that they are the basis for a certain form of risk management. We look at it and we say, you know what, 640 is a reasonably good cutoff for thinking about one risk weight or one loss parameter as opposed to another that be below 640. But now, if you tell everybody it's 640, what are you going to expect to see? You're going to expect to see a clustering of exposures at 641, right? And not nearly as many at 639, 638, 637, and all the way down, and will thereby, quite possibly, have altered that initial distribution so that it's now got more risk associated with it. And it's that kind of specific, having the code, knowing exactly what the equations in the loss functions are, that worries us most about the gaming possibility. Now, in terms of, you're right, I mean, there's always going to be some trade-off because you could have smart people like those at the Yale School of Management going over these things. We do have, internally, we do have a process that whereby we try to keep a robustness in the model making and validating process. We do an annual conference where we talk about this, so we try to have some mechanisms for interaction that fall short of giving out the code, because there isn't a way to give out, we can bring people in as formal consultants, employees of the Fed, but there's not a way to sort of give it out to the public and not give it to the banks. I should also add, by the way, that we're not in a mode where we're going to give things to the banks and not the public either. I mean, it seems to me part of this process has got to be the capacity, even if there are some constraints, the capacity of academics and policy observers and others to build on, critique, applaud, whatever they want to do, what we've done to this point.
Thank you. Yes. Oh, I'm sorry, I should have said, can you press the button and say your name so everyone can hear you?
Weber Shu, first year MBA here. It's interesting that you guys are considering removing qualitative assessments for banks under $250 billion. So if that requirement is removed, do banks still have to individually get their capital plan approved? And what do you expect the impact that such removal will have on capital return?
Right. So they still they still have to, they still have a quantitative test that they have to meet. Whoops, Ann took it down, but that thing still, you don't have to put it back up. But that thing still has to be met. The qualitative side is the risk management processes, the quantitative risk management processes, the qualitative risk management processes, the capital planning process, the modeling, and the rest. And what we saw there is a couple of things. First, for just hypothetically a $70 billion regional bank, which is essentially a commercial bank, it's entirely traditional deposit-taking, lending type functions. Precisely because they don't have a complex mix of activities, they don't have a lot of capital markets activities, we never felt that they needed to do the kind of modeling and have the kinds of systems that we thought were important for a Citi or a JP Morgan or a Goldman Sachs. One. Two, through the CCAR process itself, over the course of the 6 years now that we've had it, many of these banks have improved the processes they do have substantially, in part because they have been listening to and meeting expectations. And so we now feel that they're in a good place to have the appropriate kinds of qualitative or process type expectations monitored through our normal supervisory program. So basically, the normal supervisory program will incorporate some of those expectations, and occasionally we might have a special horizontal review to look at specific things. But I think it's fair to say that although we always said that, we always meant it, I think some of the banks were kind of uncertain because they might be told by non-Fed people, the Fed, they say that you don't have to meet those expectations, but they really want you to meet those expectations. And we just want to make it clear they don't, but also in a context in which we think that they have come to a good point in their own risk management.
Dimitri.
Hello, Dimitri Aksakov, second-year MBA. One could claim that the stricter capital requirements and stress tests effectively penalize the large organizations which are involved in complex transactions. And an indirect effect of this could be the breakup of large organizations. It could be organizations becoming smaller and more specialized. And does Fed think about such potential reconfiguration of the industry? And does it have such reconfiguration as its objective?
There's certainly not, we certainly don't have some blueprint of, how we see the industry evolving. I think or where we want to see it evolve. I think our job is to determine the kind and intensity of regulation and supervision, which will substantially diminish the incidence and severity of financial crises and financial stress, to incorporate the lessons of the financial crisis and the period that preceded it. And so as we try through our methodologies, such as the methodology we use for the surcharge, which is try to equalize the expected impact of the failure of the largest firms relative to the likelihood and thus impact of a non-systemically important firm. Those sorts of methodologies are meant to calibrate and to put a higher, for example, in this case, surcharge on those more systemically important firms precisely in pursuit of that public interest objective, which is greater financial stability. Now, we recognize that in doing so, it is possible that firms will make an assessment that certain kinds of activities, particularly some of those carried on in the pre-crisis period, may not be profitable given the kinds of regulatory requirements that exist, and perhaps particularly if you have a very large, very complex institution. But that's a judgment that they need to make. And I think some of them, and perhaps many of them, are in fact making these kinds of judgments. And if that entails changes in the structure of the company by the boards and management of those firms to align the profitability of their activities with existing regulatory requirements, we do recognize that may be an outcome of what we've put in place, but we haven't put it in place saying, we want these steps taken by these firms. We've made the regulations themselves on the basis of an assessment of the risk entailed in some combination of activity size, interconnections of the firms themselves. How they respond is really and truly up to them, which is the way it should be. If they can change the nature of some things in order to reduce the riskiness while still engaging in the activity, that's good. If they say that some of these activities may not be worth it for us given the risk that is associated with them, that's okay too. And in some cases, they might say, yeah, we have to hold more capital against it, but we still think it's a profitable activity for us to engage in.
All right, we have time for one more question. Will.
Thank you. Will Seeley, second-year student.
Press your button.
Will Seeley, a second-year student
Always
at the business
bears
school.
repetition.
My question is, you spoke about the dynamic elements of the models and how you're able to collect more information. One of the missteps prior to the financial crisis was the lack of tracking the fast and massive rise of the shadow banking industry in a lot of these models, to the extent that I understand it. How much are these models now tracking the shadow banking industry, and then new areas that are changing and new instruments as they arise?
Good question. And so it's separated too, because a good economic model should actually, in and of itself, kick out a different set of answers depending on changes that may have been taking place in the economy. So you shouldn't have to redo the model every year. But, and the last part of your question touched upon this issue, but there will be times when you become aware of a different kind of risk that may not have existed before. So, for example, with respect to some traded, purportedly safe instruments, people might have thought in terms of interest rate risk, but not credit risk, and then realized, whoops, there actually is credit risk here, at least in a tail event. Therefore, we're now going to change the model to do that. And that is one of the, when I mentioned updating of models, that's precisely one of the things that's done. It's not to say that you have to change the model every year, because as I say, the model itself should take account of varying things in the economy. But when there is a recognition of a new kind of risk or a new kind of product, that will entail a change in the model. Now, that's somewhat different, though, from saying that the model tracks risks in the shadow banking system. As I indicated in my discussion of the macro-prudential dimension, right now, there's only a limited degree to which the model will track what's going on outside of that universe of 30 banks within the broader macroeconomic and financial scenarios. And so part of this research exercise is an effort to see whether it is feasible for us to incorporate some elements that would actually take into account what's going on in those non-prudentially regulated market actors out there. And as I also said, the surcharge is in some respects a bit of a surrogate for being able to do that in an immediate model-like sense. Now, but one other thing I do want to say is, quite apart from stress testing, that lesson of the crisis to which you alluded has been fully internalized at the Fed, which is why we created originally the Office of, and now the Division of Financial Stability, which has an ongoing process of quantitative surveillance, not just of, by any means, the regulated entities that we've got, but instead of the, pardon me, of the financial system as a whole, which includes a lot of market measures, and where the data is available to us, other measures of what is going on in the, depending on connotation you want associated with the shadow banking system or the market-based finance system within the economy. And that's been institutionalized, through the quarterly quantitative surveillance reports that the division does and presents to the board as a whole. Within the LISIC, the Large Institution Supervisory Group that we created within our regulation division, the people from the Division of Financial Stability regularly brief the senior supervisors on what they've seen. So although not everything can be put into the stress tests, and I don't want anybody to walk out of here thinking eventually the stress test will be everything because everything will be in it. Although not everything can be, the kinds of things that you think about as you think about modeling an economy or modeling a financial system can sometimes lead you to say, okay, we need some sort of parallel process to make sure we're paying attention to that as well.
Thank you, Governor Tarullo.
Okay.
In a few minutes, and then we have a lunch downstairs.
Yeah. Give me a few minutes here. I got to give my...
Everything.
And also...